Down day for markets overnight. US indexes and Asian markets today are flashing red because growth data has been that way. The US August Non-Farm Payrolls data on Friday, today morning's GDP data from Japan and inflation data from China are all mostly pointing to weak growth. Jobs in the US in August rose far less than expected, and even the July and June numbers have been rather substantially revised lower. Only the hourly wages ticked up higher than expected in the US in August. So how will all these impact actions from the US Fed and other central banks? Should equities rejoice over rate cuts or worry about global slowdown? What asset classes should one bet on? I have with me a person eminently placed to answer all these questions. Neeraj Seth, Blackrock's Chief Investment Officer and Head of Asia Pacific Fundamental Fixed Income. Neeraj, good morning. Thank you very much indeed for sparing time for us today. Well, first, the August payrolls and the revisions to June and July. How are you looking at the composite data? Is it pointing to a weaker US than you thought?
So it does actually point towards a gradual slowdown that we are experiencing in the US economy. So certainly weaker than expected, but it was still a mixed report. So I think the market's focused and zoomed in on the missing at 142K, the 86,000 of downward revisions for the last 2 months. And in fact, the weakness you saw in manufacturing and retail, losing 35,000 jobs. But as you touched on briefly, there were positives. The unemployment stayed at 4.2, or in fact came down from last month. You had 80,000 job growth in construction, leisure, and hospitality, which is still doing well. And you had the average hourly earning at 0.4 month on month, which translates to 3.8% year on year, which is a reasonably healthy level of hourly earnings, which translates to consumption in a consumption-driven economy. So yes, it's clear slowdown, but it's not falling off the cliff. But there's certainly an immediate knee-jerk reaction of focusing on the weak points and, in a way, redrawing the path forward with regards to the U.S. economy, the rate cuts very, very quickly.
Okay, so how should markets, financial markets prepare in terms of the Fed? Are you still sticking to 1 + 1 + 1 in the current year? And therefore, what's the takeaway for the yield and currency markets?
So two parts. One, obviously, on the Fed and fundamentals where we go, and then what's the impact on the financial markets. On the Fed rate cut path, I still think in a base case scenario, we potentially get 325 basis points of cut this year, starting in September. There is a possibility of 50 if the CPI data in the middle of this week surprises to the downside, which is not the base case scenario I would have today. So in terms of the market impact, I still like fixed income. I think it's a great time to be in fixed income. In fact, to be in the belly of curve in the US or taking longer duration in selectively emerging markets or in Europe. And equities, now combination of the September seasonality, upcoming political elections in the US, I'm a little more cautious with regards to potential increase in the volatility in the coming months. And specifically, September is never a great time from a seasonality standpoint. So I think the markets need to embrace for some volatility in coming weeks to next couple of months.
Okay. But what would be the range for the 10-year for you from now to end of year? Or even 12 months?
So I think in some ways there's a slight asymmetry at the 10-year point, more to do with the fiscal financing and less to do with the Fed rate path. So you can see a mid-threes on a 10-year, but you can obviously see backup going back to a 4% level. So I think we're sitting in the middle of the range right now, but the overall yield and carry that you can build in your portfolios gives you the cushion to actually counter some of that. But I do think you will see, but if I put it in very simple terms, the bull steepening of the curve, which is the front end keeps coming lower, even though it looks overdone for now, with maybe some steepening of the curve between 2 10-year part.
For the next 12 months, do you see migration of smart money from equities to bonds, especially in the US?
I don't think that's necessarily the trade I would focus on. I would look at more of the money moving from the sidelines, the money market funds, savings, the short end of the treasury to more into risk assets and fixed income. US equities, I think, still are well placed unless you see a big risk of recession going higher or the soft lending scenario turns towards a hard lending scenario. So I think the equities are placed okay in terms of where they are. obviously with higher volatility. But you do have close to $9 trillion in money market funds globally, with a significant majority in the US. You have a very heavy ownership in the T-bills right now, given what they're yielding. So I think there's a significant amount of capital sitting there, which even a part of it gets reallocated. I think that will come into your risk assets, specifically in credit, for locking in the yields where we are in this scenario.
Okay, your base case is the U.S. economy is still, decent for people to bet on equities. Let me come to Asia. Japanese growth is lower than expected. China, I mean, inflation is just not budging, 0.5%. Do you see a fairly severe fall in, core inflation everywhere because of commodity prices falling? Our commodity expert was telling us that copper, several iron ore are all trading at multi-month lows. So is there a disinflation on in Asia?
So not in Asia, but you do have the disinflationary pressures in China, right? The data at 0.6%, which includes, in fact, the volatile food and energy. If you take that out, it was 0.3% for CPI this month, or this data that came out today. PPI was still minus 1.8%, which was, again, deeper in negative than expected. If I take a step back and look at what's happening in the economy in China, there's a structural shift towards more state-owned enterprising taking market share. The consumer sentiment, and that's a critical, remains weak due to a lack of job growth, lack of wage inflation, and the wealth effect coming from the negatives from the real estate sector. So all in all, the Chinese economy is still in a muddled-through scenario with a weakening bias, and hence you're seeing that playing out through the commodities, specifically the hard commodities ex-gold, as well as to some extent oil, which I think will continue unless you see a rebound in the activity in Chinese market.
I'm building all this to your expectations on India. I mean, if there is this Chinese disinflationary overhang, as well as the US Fed more likely to cut than not, what's the expectation? Do you think India will also change stance and then cut before the year is out?
I do think in a base case scenario, I would expect RBI to move in December. Now, key is obviously we have the inflation CPI print expected this week, which I would expect to be in the mid-threes given the base effect and the food prices a bit better behaved. The monsoon has been okay, so we'll see how that plays out in rest of the year. But with the Fed cutting and the inflation maybe undershooting a little bit compared to the RBI expectations for this quarter and next, I do think there's room and potential for RBI to start moving in December. The key is the commodities, the oil price, both from an inflation as well as a macroeconomic perspective in terms of trade, it's actually a positive for India right now in terms of the backdrop.
That was, I mean, you're giving me the cue to the question that was in my mind. If you look at the global indexes, the active ones are still not really in India. They are quite deeply in developed markets. Do you think this jump will come as both the global macros look India positive because we are net commodity importers, as well the local situation is likely to become easy liquidity?
I do think the gradual shift is already happening. As you saw the MSCI IMI index increasing India's weight now to the largest as a single country above China. In the standard one also, India is reasonably high, just behind China. You're seeing close to now $15 billion of inflows in the bond market, out of which north of 12 is just on the back of index inclusion, where we have only gone from 0 to 3%. We have another 70% as into 10% yet to go. So we're seeing this integration of Indian capital markets, and I would say a little more tilt towards debt at this point. Yeah. But as the markets remain buoyant, and if you do in fact get corrections, I do think the equity will see more flows in India, which we haven't seen as much this year.
Exactly. I mean, I have no complaints about bonds. There has been a decent inflow of fixed income money. But equity funds are still not looking at India as much as we would have thought. Many of them are underweight, the active funds. So, I mean, if you were to advise them, would you advise step in? And what is your worry about valuations? In spite of the valuations, will you pick any sectors?
I think I would still stick with some of the growth sectors in India, more in the large cap. The valuations obviously look rich, but at the same time, this is when you start looking at the active management and look under the hood in terms of both the sectors and the companies which are less inflated in the valuation terms. And if I have to do it, I'll still be actually gradually still continue to build exposure in India, given if I take a 5 to 10 year view, it's still one of the best macro stories in the world, and it's hard to completely ignore it.
Okay. If you could be more specific in terms of which sectors you will pick right now. I mean, if you will talk stocks, nothing like it, but...
No, I unfortunately can't. Maybe we take that offline. I still like actually the IT services, the financials, some of the domestic stories in terms of consumer. The discretionary side actually is becoming more interesting in India as you get through a certain GDP per capita. So I think if you look at asset management industry, all those have secular growth trends. And I think that certainly is something which I'll be positive on. And lastly, I think the decarbonization effort, as you have seen the renewable power sector, I think they have a long runway for growth in India when you look at the government plans and the implementation from here.
Okay. Well, let me try and squeeze a last one. If you have to advise some rich person with money, what will be the top 3 asset classes you will advise?
For India or for global?
Both.
So I think where we are, I still would actually be, you always want to have obviously an asset allocation framework where you have exposure to the growth sectors in equities. I do think we still want to keep that. One area which I think is actually still under owned is the emerging markets, local currency, and maybe more selective. So the local currency, government bonds, and high quality credit. I think that's a very, very interesting sector, specifically given the shift in the Fed path from a rate perspective, opening the room for emerging market central banks to cut. And the third is private markets, and within that specifically private credit and infrastructure.
Okay. Now that calls for a separate discussion altogether, private credit and infrastructure. Thank you very much, Neeraj, for sparing time with us and whetting our appetite as to how to look at asset allocation and the interesting sectors that you point out in India. Well, on that optimistic note, wrap up on Bazaar. Chartbusters coming.